Mid-2026, Bitcoin markets are defined by a massive contradiction. Looking past the price, we see two completely different signals colliding. Synthetic derivative markets flash extreme bearishness, while underlying spot behavior shows relentless accumulation. We see the bearish signal in derivative markets through persistent, deep red negative funding rates. Short sellers are actively paying a premium, committing capital to maintain downward pressure on the price and betting a further collapse is imminent. Yet the on-chain data shows the aggressive expansion of long-term holder supply occurring at this exact same time. This creates a unique paradox. High-conviction actors are absorbing spot inventory as quickly as traders are betting on a crash. This specific divergence characterizes a structural macro valuation reset rather than a sustained bear market. To resolve this tension, we must deconstruct the underlying cost bases of market participants to map exactly how risk is being transferred between cohorts. We focus on two primary groups: short-term holders, the recent entrants and speculators, and long-term holders, the veteran accumulators. Standard technical analysis fails to capture this shift because surface-level price action ignores the age and conviction of the coins changing hands. Mapping the current localized derivative stress requires us to first zoom out and evaluate the profitability of the entire network. Decoding this data contradiction allows institutional managers to accurately gauge the true market trajectory for the remainder of 2026. The shift in the macroeconomic regime began immediately following the market peak in late 2025. This is the MVRV Z-score, a metric used to evaluate aggregate network profitability. Notice the orange Z-score line's sharp drop from the 2025 peak down to its current consolidation levels. The Z-score's exit from the upper red zone indicates that the network has successfully flushed unrealized profit from the system. We can cross-reference this reset with net unrealized profit and loss, or NUPL. This tracks the total ratio of profit held by the network. The blue line shows a clear transition from the euphoria and greed phase into the current consolidation bands. Comparing this 2026 cooling phase against the deep green capitulation levels seen in 2022 suggests the network remains structurally sound. This macro data points to a healthy reset of market froth, setting the stage for localized battles over specific price support levels. With the network stabilized, we shift our focus to the localized friction points created by cohort cost bases. This chart displays the short-term holder realized price. The orange line represents the average acquisition cost for recent market entrants. This cost basis serves as a critical psychological and momentum threshold for active traders. Throughout 2026, the black spot price has repeatedly dipped to test and occasionally break this orange STH support line. When price falls below this level, short-term holders are plunged into unrealized loss, which typically triggers spot panic selling. This localized panic feeds the negative funding rates we saw earlier, as short sellers pile on to exploit this fragile cohort. The fragility of these new entrants stands in contrast to the insulation of long-term holders. This chart shows their distinct cost basis. The massive delta between the LTH cost basis and the current spot price, combined with the rising stair-step pattern, protects veteran accumulators from this localized volatility. This wide delta creates two parallel market realities: intense stress for recent buyers and relative calm for those who have held for years. We can now track the mechanical process of how supply transfers between these two groups. This is the UTXO maturation cycle. To cross the threshold into long-term holder status, coins must remain dormant on the blockchain for exactly 155 days. This chart tracks that maturation in real time. The blue shaded area represents the total supply held by long-term holders. An inverse correlation is visible here. As price consolidates sideways, this illiquid supply rises aggressively. These capitulation events, where short-term holders sell at a loss, provide the exact inventory that long-term holders are scooping up and aging. This absorbed supply is being systematically removed from liquid circulation, draining the market of tradable inventory. If such a high volume of supply is being absorbed, we must ask why the price hasn't yet responded with a move higher. Stealth accumulation requires time to churn through the overhang of synthetic derivative shorting and the remaining short-term supply. The steep, uninterrupted rise in LTH supply during price weakness quantifies a period of high-conviction spot accumulation. Bringing derivative sentiment and on-chain reality together resolves the contradiction identified at the start of the year. Mapping the negative funding rate spikes directly beneath the STH realized price interactions shows exactly how these two datasets interact. The derivative market is purely reactionary, spiking into deep pessimism only when short-term holders fall into unrealized loss. Adding the LTH supply growth to this comparison shows that these moments of derivative panic correspond with peak spot absorption by veteran holders. Derivative traders appear to be pricing in a macro failure, while the data indicates a localized liquidation of recent buyers. This bearish sentiment in the derivative markets provides the necessary liquidity for long-term holders to build their positions at a discount. These negative funding rates represent a standard cleansing of weak hands rather than a macro warning sign. The current market structure has significant implications for the remainder of the 2026 cycle. Relentless absorption by long-term holders is establishing a structural price floor that is difficult to break. This leads toward an inevitable supply shock. Once the structural floor holds, derivative short sellers will be forced to buy back in against a depleted liquid supply. For quantitative managers, the lesson is that derivative sentiment in digital asset markets is often fleeting noise. The current market is executing a massive wealth transfer, rewarding verifiable on-chain conviction over synthetic speculation.